Thank you very much for having me, as always. I wouldn't look too heavily into the data that's released today, because although the headline looks quite concerning, because the headline is that this is the weakest GDP reading in China since 2009, the overall growth for China is still in line with government forecasts, and it's still in line to hit the government targets for 2018. Now, what I would link the lower GDP reading today on the quarterly basis out for is that there's a lot of concerns over external uncertainties and what risk this could present to the global economy. We just concluded the IMF conference in Bali last week, where the IMF downgraded global growth forecasts for 2018 and 2019. Now, this was the first downgrade in global growth outlook for 2 years. And also there was concern and comments about the potential that global growth might have plateaued, perhaps global growth has hit its peak, and we're seeing other GDP readings, not just in China, signaling some sort of slowdown with the global economy. So it probably falls into the global scale, and there's nothing specific that's probably weighing on it from the side of China as a idiosyncratic event.
Yeah, it's all about sentiment. But here in China, a years-long de-risking campaign has driven up borrowing costs and weighed on activity. Will Chinese authorities ease monetary policy to mitigate the impact? I mean, already in the first week of this month, we already see a bank reserve requirement cut. What tools, other tools are available?
It's a very good question. When you consider that the PBOC and authorities only recently cut the reserve ratio requirements at the beginning of October, it's more likely that they will continue to stay unchanged for now. But if the market begins to get uncertain over US interest rate policy, or that China might need some extra stimulus, we could see this change at the turn of 2018. Now, in terms of what stimulus they could potentially use, there could be more cuts to reserve ratio requirements. More unexpectedly, they could cut benchmark interest rates to be in line with the Federal Reserve US policy, or there could be some other fiscal and corporate incentives to encourage more investment into China, whether that's a potential change in tax policy or somewhere along those lines, just to provide some more investment sentiment. But for now, I do think they'll probably leave policy unchanged, and we don't need to be too concerned over the GDP reading from today.
Right. Asian stocks today are down on China growth data, and overnight in the US, the market is also weak. How do you think China's slowing pace will affect the world market and currencies?
When you consider the importance of China to the global economy, you can't downplay that a GDP reading missing expectations could weigh on investor sentiment. Having said that, it's not the individual catalyst that is moving the financial markets right now. You've got the IMF cutting growth downgrades for the next 2 years.
Yep.
You've also got US interest rate policy, a massive move higher in US 10-year Treasury yield, and you've got President Trump now speaking more actively against the Federal Reserve, along with other uncertainties in the external environment, along with Italy, the German election from last week. You've got the budget in Italy as well, and then you've got the Saudi Arabia investigation that's still ongoing. So there's a couple of different layers of complexities that could impact financial markets, and I wouldn't look at China or the isolated GDP reading as being that much of a massive driver for the global economy. You also have to take into account the markets have been selling off for the past 2 weeks. So there wouldn't be a necessary change in sentiment on an acceleration in selling momentum following the GDP reading today.